Medpace opened 2026 strong, but the real story is whether this beat, backed by margin resilience, deserves the company's premium multiple. We've got 4 key areas to cover: the massive revenue surge, the internal engines driving their margins, the looming risks in their project pipeline, and the final valuation synthesis that every investor needs to see. The numbers are in, and they are big. Revenue hit $706.6 million, up over 26% year-over-year. Earnings per share also jumped 16.6% to $4.28, significantly outpacing what the street expected on both the top and bottom lines.
What's driving this? It's a mix of metabolic trials and strong pricing power. Even though they saw a surge in low-margin reimbursed expenses that pinched gross margins by 410 basis points, their adjusted EBITDA still grew nearly 26% to $149.4 million. Here is the primary engine. Metabolic revenue skyrocketed an astonishing 60.5% year-over-year. Medpace is effectively capturing a massive share of the GLP-1 obesity and diabetes trial market, which now makes up 31% of their total revenue mix. How did they protect their 21.1% EBITDA margin despite rising costs? They used stock-based compensation as a buffer. Total SBC collapsed 71% this quarter, a $12 million drop that perfectly offset higher personnel expenses. The cash conversion here is pristine. Operating cash flow hit $151.8 million. After accounting for capital expenditures, they walked away with $145 million in free cash flow, maintaining a highly attractive yield for the CRO sector. Check out this debt profile. It's zero. Medpace is completely debt-free as of March 31, 2026, with a robust cash position of over $652 million, which has grown by $155 million since the end of last year. They aren't just sitting on that cash. After a massive $389 million buyback in early 2025, they still have over $821 million remaining in their share repurchase authorization to support the stock price.
It's not all sunshine, though. The net book-to-bill ratio dropped to 0.88x, falling below the long-term average of 1.03x. This suggests the project pipeline is draining faster than it's being replenished, which could mean slower growth by late 2026. The second major risk is customer concentration. 84% of Medpace's revenue comes from small biopharma. This makes them hypersensitive to the biotech funding environment and any shifts in interest rate cycles. So it's a battle between the bulls and the bears. On one side, you have massive GLP-1 tailwinds and elite scalability. On the other, you have pipeline pressure and that heavy 84% reliance on small biotech funding.
Is the growth real? Our diagnostic says yes. While SBC masked some costs, the operating cash flow actually exceeds net income, which is a hallmark of high earnings quality and proves there are no one-time gimmicks at play. Why does Medpace trade at a premium? It comes down to 3 structural advantages: a debt-free balance sheet, elite 97% free cash flow conversion, and unrivaled dominance in the GLP-1 market. The Q1 beat was massive, but the 0.88x book-to-bill is the number to watch. What therapeutic area do you think poses the biggest risk to their guidance? Let us know your thesis in the comments. If you found this Medpace earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.